Now that we've completed part 1, including total revenue, total expenses, and net income, we're going to see how that activity translates into the organization's overall financial position. The balance sheet answers a simple question: what does the organization own and what does it owe at the beginning and end of the year? And most importantly, does it match what we calculated in part 1? Understanding the structure, you'll see two columns. Column A, beginning of year. This reflects the organization's financial position at the start of the tax year. Column B, end of year. This reflects the position after all activity from part 1 has occurred. Think of this as beginning balance plus net income equals ending balance. Line 22, cash, savings, and investments. This line includes all liquid assets, meaning funds that are readily available. This typically includes checking and savings accounts, investment accounts, and cash on hand. For example, beginning of year, we'll input $40,000. This reflects what the organization had available at the start of 2025. For the end of year, we'll put $69,000. This increase reflects the $29,000 surplus we calculated in part 1. This demonstrates how operational results directly impact cash position. Line 23, land and buildings. This line includes long-term physical assets owned by the organization, such as property or facilities. These are not day-to-day operating funds, but rather assets used to support the mission. In our example, the organization owns a facility valued at $15,000. There were no purchases, sales, or depreciation adjustments. So we'll enter $15,000 in column A and $15,000 in column B. This shows stability, no change in fixed assets during the year. Line 24, other assets. This line captures any assets not included above, such as equipment, prepaid expenses, and receivables. In our example, there are no additional assets to report, so we'll leave both columns blank. Always use this line if something doesn't fit in lines 22 or 23. Line 25, total assets. This line totals everything the organization owns. It is calculated as line 22 plus line 23 plus line 24. For our example, at the beginning of the year, $40,000 plus $15,000 plus 0 equals $55,000. For end of year, $69,000 plus $15,000 plus 0 equals $84,000. These values should auto-populate. This represents the full financial resources of the organization. Line 26, total liabilities. Liabilities represent what the organization owes. This can include loans, credit balances, and accounts payable. In our example, the organization has no outstanding debts, so we'll enter $0 in both columns. If liabilities existed, they would reduce net assets. Line 27, net assets or fund balances. This is one of the most important lines on the entire form. Net assets represents the organization's true financial position after liabilities are subtracted. The formula is total assets minus total liabilities. For our example, at the beginning of the year, $55,000 minus $0 equates to $55,000. And at the end of the year, $84,000 minus $0 equals $84,000. Here's the key validation step. Line 27, column B, must match part 1, line 21. From part 1, we calculated ending net assets equals $84,000. And here, line 27, column B, equals $84,000. These match, which means the return is internally consistent. Here's the big picture. To summarize how everything connects, part 1 shows how money moved during the year, such as income and expenses. Part 2 shows where the organization stands financially at the end of the year, and the bridge between them is net income, line 18, increases net assets, line 27. Here's the key takeaway. The balance sheet is not entered in isolation. It must reflect the starting position from the prior year, the activity from part 1, and the ending financial position of the organization. If these numbers don't align, the IRS will flag the return. Now that the balance sheet is complete and fully reconciled with Part 1, we'll continue with Part 3, Statement of Program Service Accomplishments, and Part 4, List of Officers, Directors, Trustees, and Key Employees. In the next section, we'll describe how the organization used its resources to carry out its mission, and then report key leadership and compensation details to ensure full transparency.